Hello everyone. In extremely hawkish news coming out of Federal Reserve, rumors are that emergency rate hike may happen sometime this month and possibly as soon as tomorrow. Why is this happening? Some of you may have heard inflation numbers or CPI numbers that came out today were high or higher than expectations, and that has led to more hawkish stance from Federal Reserve. So yeah, let's quickly go through this. With punditry obsessing over the March FOMC meeting, where odds earlier today hit 100% of a 50 basis point rate hike before easing modestly, and there may be more than 6 hike altogether in 2022. At least that's what the people are betting on, or market is betting on. The real action is in February Fed fund contract, which has spiked to 13 basis points, suggesting 5 basis points of tightening relative to the effective Fed fund rate of 0.08%. So it's somewhere around here today, and the expectation for the month of February is now 0.1325%. So people are expecting hikes as soon as this month, and not even waiting for March. For March, 50 basis point seems to be 100% now, or probability now. Why is this notable? Because the February contract expires on Feb 28th, more than 2 weeks before the March 16th FOMC decision. This means that someone is preparing for an inter-meeting rate hike sometime before March. So why inter-meeting? Because the next Federal Reserve meeting happens on 16th of March, and any rate hike before that is inter-meeting, and chances are looking that it may happen. And plugging in the numbers, the 13 basis point in the Feb contract means that there is now 30% chance of an emergency rate hike. So 30% chance of this happening this month. Interestingly, this is quite paradoxical. Why? Because Federal Reserve hasn't completely shut down the QE. So they are printing money to buy bonds and mortgages. They are supposed to shut them down by middle of March, or next March 16th FOMC meeting. So if they are printing money, what's the logic of urgent rate hike now before that? It may sound paradoxical, but either there is a pressure on Federal Reserve from government to control the inflation, which has come out hot today, or they are themselves panicking and raising these interest rates in anticipation of even more higher inflation in future, or more inflation in future. And the biggest, we may soon face the monetary paradox of Fed hiking rates, even as the Fed is still easing monetary policy through QE, which I just mentioned. And the biggest joke here, the Fed would be tightening conditions to contain inflation that is almost entirely supply driven, and which the Fed has no control over. So this is also very interesting. Lot of supply chain disruptions have caused this inflation. Not to mention, a lot of it was because of the stimmy checks that were printed over last 2 years because of pandemic crisis. But majority of those that stimmy checks impact is already reflecting in the prices. So no new inflation because of stimmy checks and the money printing that was directly coming into the economy is potentially over and no longer going to be impacting inflation further. So going forward, majority of the inflation would be because of supply chain disruptions and things like that, which Federal Reserve has no control over, and they are going to potentially be making mistakes by hiking these rates. So yeah, that's the urgent kind of news or breaking news that emergency steps are now being taken by Federal Reserve to control inflation. Whether it does make any impact or not remains to be seen. I don't think so. Um, Again, but there are some short-term cross current that may play. For example, if there are rate hikes, then they will be reflected in stock market going down in short term. On the flip side, the buyback season has started, which will be ending sometime middle of March as well. So a lot of buybacks potentially may happen. That may help keep the stock market high. So it's possible that both these counter currents might cancel each other, and stocks might just go sideways from here on, at least in short term. Long term, as you guys are already familiar, my base case is that Federal Reserve will try to hike interests maybe up to 1%, but then things will just crater, or economy will crater, and that would cause them to reverse all these steps, and will lead to much higher inflation, because they will have to go back to QE, more stimmy checks because of recession and stuff, and higher inflation. Not to mention these supply chain disruptions will have a continued role to play in keeping the prices high anyway. So yeah, that's the news, and I will see you in the next one. Bye.